Hi, morning, Stephen. Thank you so
Hi.
much for your time, for being here.
Yeah, Ellen, thank you for having me.
Great. So you ready?
Yes, let's go ahead.
Great. So your client is White Sand Capital Partners, a large asset manager based in US with $5 trillion in asset under management, which is AUM, and the pers- uh, and pre- and the presence in all large financial centers around the world. So Western was known for having some of the best talent in managing fixed income products in the past and are continually expanding their product offering to clients by acquiring a number of other asset managers with different strengths. Despite AUM growth in both of their customer segments, which is retail and institutional, and being the largest asset manager in the world, White Sand has recently been facing declining profitability and shareholders are demanding a shift in strategy. The CEO of White Sand has brought you into a dialogue the problems and to help them to turn the firm's share price around.
Absolutely. Thank you for the case. So just to recap, our client is White Sands Capital Partners, and they are an asset management company with $5 trillion in assets under management. They are looking to increase their profitability and ultimately increase their share price after a period of decreasing profitability. Is that correct?
They're not listed, just increase the profitability.
Just increase profitability. They're not listed, I see.
Yeah,
Um,
so change the shareholders, it's shareholders they're invest, they
mhm.
have their money under management.
Absolutely, yeah. Excuse me. Yeah, shareholders' money under management. Thank you. So just to clarify, are there any specific metrics for success that our client would like us to keep in mind?
Uh no, just improve the profitability. They don't have a specific number in mind.
Absolutely. Okay. Thank you. So you said they operate in both retail and institutional banking. Do you have any information on what countries or what locations that our client operates primarily in?
Uh the location is not the key factors.
Okay, great. Thank you. Beyond that, is there any information on the distribution of assets under management of our client?
Uh you mean you mean by assets or you mean by product type
Yeah, by
or
product lines. Yes.
oh, we can disclose such info later.
Okay, absolutely. Let's see. Do you have any information on what kind of who our largest clients are, who our largest shareholders are?
So you mean, are you asking any specific customers or are you asking?
Our largest institutional customers.
Oh, yeah. So if you are asking a customer segment, we can put it simple. There are just two segments. One is retail, one is institutional, and they are split 50-50.
Retail 50/50. Retail institution 50/50. Okay, I see.
Yeah, but the institutional segment is growing faster.
It's growing faster. Thank you. Do we have any major competitors in our banking space that are operate on the scale that our client operates? And what our
Oh,
market share would be?
yeah, we do have competitors, um, but we are the largest and we have the best talent.
Great, thank you. And just a quick question. So I just want to clarify, what does it mean by the best talent? Do they mean that are the
They
people
are
that
very competitive.
they're very competitive? Do they mean they're more likely to beat the market? They have better investment strategies? Is that what you mean by? best talent?
No,
Okay. What would you mean by that?
they're just they're good in name. They have good brand.
Oh, good brand. Okay, I see. Brand. Okay, great. Thank you. So I think that's all the information I'll need for now. Do you mind if I take a moment to structure my thoughts, and then we could come
Sure,
back
take your
together?
time.
Go over more. Thank you. Great. So you mind if I come back and go over my approach with you?
Sure, please.
Absolutely. So in our class objective of increasing profitability of our client, I'd like to look at three buckets regarding our how to approach this problem. So first, I'd like to look at, of course, the revenue and then as well the costs of our bank. And then finally, I'd like to look at the overall market trends internationally. So in the revenue, I would like to look at our fees that we charge for our services, as well the returns we have on our investment strategy, as well the loans that we give out, ultimately resulting in a return. And as for our costs, I like to look at the fixed costs that involve the salaries that we pay our asset managers and the salary we pay for our for our assets and other fixed costs such as our office spaces and other physical locations that we might run, as well as variable costs, including defaulted loans and defaulted assets that our clients cannot pay back. And finally, I like to look at the overall market and the trends that the market is the overall economy that we're operating in. So including the behavior of central banks in the countries we operate with, the interest levels and the levels of income that are increasing, and whether or not the overall economy is strong, as well if there are worldwide trends, even so much as a pandemic or a war or other aspects that would impact um, the the behavior and performance of our clients' assets. So in this objective of increasing profitability, I'd first like to look at initially what our current revenue and costs are and the trends that our client experienced in its profitability. So is there any information on what the current behavior of our client's balance sheet currently looks like?
Sure, I could share you some information uh, of their current revenue segments. So then you can have a better understand what we have in our product portfolio.
Absolutely.
So for 1 second. Yeah, tell me what you think.
Absolutely. Thank you. So in this exhibit, we see the asset class expense ratio of basis points of 1/100th of a percent. And we see a list of different assets that our client manages in the year 2016, 2018, and 2020. And just as a note, the expense ratio is the fee paid by client to White House on each dollar of assets managed. Okay. And we see on each of the asset classes, we see the basis points 100%. So right away, it looks like of all the years and across all the asset classes, the U.S. equity, U.S. fixed income, U.S. equity passive is greater than that of U.S. equity active is greater than that of passive, fixed income active. So it looks like the active asset classes are of higher basis points than that of the passive. However, it looks like across the board, every single asset class has been decreasing in its expense ratio. So expense ratio being the fee paid by a client to White Class on each dollar of asset managed. Okay, so that means no matter what the asset class is that our client offers its clients, all the expense ratios are going down. So it doesn't seem like that this is then a problem in specific asset classes or specific assets that or products that our client. This hints toward a wider economic downturn or some kind of overarching lowered performance of all our asset classes. So from this, I'd like to look at, it looks like the active classes are the greater source of expense fees paid by a client. And so would there be any information on particularly the international equity and international fixed income? Is there any information on why the active asset classes are lowering in their expense ratios?
So what's your main observation? What's the main conclusion that you can draw from the exhibit?
The main conclusion I can draw is that despite in all asset classes, the expense ratios are lowering, however, as well that the active asset classes produce a greater expense ratio than the passive asset classes. And so with the active classes being the greater source of fees, the greatest source of income for our client, I'd like to look at increasing the expense ratios for the active classes. And it looks like the overall behavior of the market is lowering all expense ratios. I'd like to see how we can improve the expense ratios of our active asset classes. So that's what I like to look at. Is there any information on on the greater market landscape of why the expense ratios are lowering?
Great. I think you are absolutely right about the all the products are gradually declining, contributing to the declining revenue. As you can see, the ratio is declining. But however, and you can tell the active products are more expensive, right? And they cost more. But actually the return between the passive and active classes are about the same.
Okay, the return are about the same. Okay.
So yeah, the return are about the same. So it's probably not necessary to draw the conclusion that we need to
so the returns are about the same.
Yeah, the return are about the same. So how's that information change your conclusion?
So because the returns are about the same and the passive asset classes have a lower expense ratio, we would instead look to how we can increase the profitability of the passive or increase the revenue brought in by the passive asset classes. So would there be any information on why the passive asset classes are declining in their expense ratios?
We don't have a specific number for now, but could you what would you recommend for next step? So from your understanding, what would you recommend White Sand to do to increase
Absolutely.
increase the revenue?
could I have a moment to come up with some ideas?
Sure. And you may also want to consider the customer segments. So different, we have two segments. One is retail, one is institution. Their behavior are different.
Absolutely. Just a quick clarifying question. What's the difference between equity and fixed income asset classes?
They're just two different products. So
Two different-
equity, which means you help your customers manage assets in equity market, which is stocks. So
Stocks.
fixed income or bonds.
Okay, great. Yes. Yes. Thank you. So, okay, the goal is to increase the passive the performance of the passive asset classes. Right. So, Ellen, I'm kind of
Sure,
in what
go ahead.
yeah,
Ask.
in what so in our what would you recommend our client to do? I am sorry, I'm really quite lost. Just between you, I am not sure how this
So, I
maybe
mean, you
works.
already captured the main trend. We are facing a declining fee, right?
Yeah.
We're facing a declining fee. And so that's probably the reason of we're facing a declining revenue, right?
Mhm.
So all our products are generating a declining revenue because even though the volume is increased, but the percentage that we can charge our customer is declining, right?
Yeah.
So I mean that's probably the reason. So how to fix that? So given that, so all our products, those are all the conventional products like equity, fixed income,
Yeah.
international equity, international fixed income. That those are pretty standard assets, stock
Mhm.
and bond. So what could we do? So to
Um,
increase revenue.
yeah, so to increase revenue, perhaps we can look into new asset classes to besides our equity and our fixed income. So perhaps possibly introducing a new into a new class of assets, perhaps perhaps
Great. I mean,
yeah,
we could consider launch a new asset class. We could launch like
the
we could
housing
launch a
market
new
or
product.
yeah.
Right. So what kind of products you are considering? So what's based on the information that you have at this moment, so
Absolutely.
should these products target which client segment and what kind of products you are considering to launch?
Absolutely.
What
Okay.
make a good product to increase our revenue?
A good product to increase our revenue. Absolutely. So just a brief second to gather my thoughts. So a couple ideas I have for introducing new asset classes because all of our current asset classes are decreasing in their fees that could be charged. Two ideas I had is possibly looking to the housing market, possibly introducing um, housing into our product line, as well as commodities such as gold and lithium, and even so much as corn as oil into our asset classes. So introducing new asset classes into our clients' product line. So would there be any information on what are asset classes that are performing well in this
You want to remember that. So at this moment, both our active products and passive products, the return are about the same.
The return are about the same.
So there are, I mean, let me recall some important information for you. So one is now all the fee we charge, the percentage are declining. That's one fact. And also the return between the passive and active classes are about the same. And you already drew the conclusion. So the money, which means the money probably would flowing from higher fee to lower fee products. Because the return are the same, so why not choose a cheaper one, right? Then what should we do? How should we? And also, so at this moment, our retail and an institution are about 50-50, but the institution growth are faster than the customer than the retail.
Institution is faster. And okay, so institution is our customer segment that's growing faster, as well, like you say, the returns that we get from both active and passive asset classes are about the same. However, the fees for the passive asset classes are lower, so it looks like the institutional passive asset classes are more attractive for the investors. And so coming up with ideas to improve to add new products into our institutional passive product line. And so to institutional being such as bonds, or as opposed to active, as opposed to retail, such as so
the fact is the institutional customers is likely to pay higher fee. They want to get higher returns, and they are capable of paying higher fees. But the problem is we don't have such products.
Exactly. So we would move to more riskier assets that would give higher returns despite the lowering fees. So riskier assets, including
yeah, we can do the brainstorm later.
Okay, yeah, thanks. I guess my background on this industry is not so well versed, but yes.
You could ask more questions. Yeah, you could ask more questions about the how the industry works. Yeah, you could ask me. I would
absolutely
love to provide more information if you ask.
Absolutely. So just some quick questions. Equity being stocks, and with fixed income being
Bonds.
fixed income being bonds. I mean, this is the point of the brainstorm, but what other financial products are largely, so there are commodities, there are physical products that can be traded, there's stocks and bonds, there's real estate, there's for example, or there's like mortgages. I'm just trying to come up with other assets that can be traded by perhaps debt, perhaps they can trade
Yeah, I will show you some other category of products and with their how about and the return later. Okay.
Okay, absolutely.
Yeah, great. So
So moving forward, would there be um so we want to increase our investment into institutional passive assets.
why passive?
Oh, passive due to their due to their but however we want higher returns. So just to recap where we're at, we have we have the same we have there are there are higher fees paid for the active asset classes. However, active and passive, they return the same.
No, I mean, when I talk about the return, the same is the products we have at this moment.
Mhm.
Their return are about the same. It doesn't make so if all the active products returns is about the same with the passive, then people will not invest proactively.
Oh, okay. This
So
is
yeah, the returns are about the same. Is the fact about our current product portfolio.
our current product portfolio. Okay. And just to make sure, so does our current product portfolio include all of these asset classes, or this is currently the market as a whole?
That's the is not we our portfolio cannot represent the whole market.
Exactly, exactly. Okay. Oh, I see, I see. So, okay, so we currently have retail and institutional, and however, okay, we have currently retail and institutional is growing faster, and so that means that the the equity institutional being the so does equity fall under retail or institutional customer segments?
I mean, they both invest. They
Oh, I
both
see.
retail and institution could invest
I
equity
see.
or
Yeah,
fixed income.
they're customer segments that could go into that could buy each. Okay. Okay.
So yeah, so moving forward, we could launch a new product that meet our institutional customer expectation, which is and also we want to increase our revenue. So we better look for a high yielding products and with with higher fee. So yeah.
Great. Yeah, so a higher yielding product with higher fee. Okay. Would you like me to brainstorm ideas for that new product, or could we look at
We can keep that for later. So what kind of so what's next? So
right?
given though that we need to fix our revenue problem by just launching a new product, and what's next?
Um, fixing our so I'd like to look at the current breakdown of our company's products and seeing our clients' products and seeing where possibly our product line can expand. Is there information on our client's current product line?
Oh, I'm showing the current product
Oh
line.
yeah, that is our current okay. This is all the okay, yes, these are all the current product lines. However, out of being split between equity, fixed income, and US and international, um, are you suggesting um seeing which of
No,
these
I mean where you want to drive the case. What's the next step?
to drive the case the next step? Since we want to in um we want to introduce high yield products with a large fee, with higher fees. I'd like to look at expanding on the international equity and international fixed income active classes to see if there are products in those asset classes that we could expand on due to their high fees and expense ratios. So is there any information on the current products listed in the international equity and international fixed income active asset classes?
So may I ask why in the you mean okay.
They would be the highest.
So I mean that's not necessarily so we can see the return in our product portfolio, the international equity and international fixed income are higher, but does not necessarily reflect the return on the market. So I could show you some products that we are currently considering
Oh, right, some current products.
to enter into.
Thank you.
So for 1 second.
Right, since we're looking to introduce new product lines, we can look at what product lines are really being great. So thank you. So in this second exhibit, we see the private equity index returns yearly by percent, and with the percent being on the y-axis and different new products that could be introduced to our product line, 2016, 2018, and 2020. And just as a note, total fees is management fees times the right, it was the asset under management plus performance fee times asset management times return minus hurdle rate. Let's see. So the private equity index returns, they seem to be stable for leveraged buyout. However, venture capital and distressed debt seem to be quite volatile. And if our goal is to increase the higher yield products with in turn be large fees, I would look into the venture capital product lines due to its higher volatility and greater risk, potentially with greater returns due to its the private index return being 23 in 2016 and 14 in 2020, as opposed to the other private equity indexes that are much lower in or less volatile. I'd like to look at possibly introducing venture capital into our client's product line.
Great. Then yeah, I mean that's a great great start.
Insight, yes.
Yeah.
So from that,
that's a great start. So could you calculate I mean you already give your first thought which type of fund Whitestone should launch, so which is venture capital. So could you calculate the fees on each type of private equity fund?
Absolutely. So calculate the total fees on each private capital.
So assume the hurdle rate is 7%.
Hurdle rate is 7%. Absolutely.
And we have 3 billion to invest in each fund.
In each fund. Okay, and just to clarify, that's okay, 3 billion in each fund. Okay.
Yeah. Do you want me to clarify how they charge their fees?
Yeah, that would be yes. So just so for each return, this is the return before or after the fee. This would be the return for the asset. And so how would the fee be? The fee would be taken from the return.
So actually, so private equity charge fees uses a 220 model, which means a private equity charge a fixed fee and a variable fee. So for the fixed fee is the 2% of the asset under management. And about the 20%, about the 20% is for the returns that passed the hurdle rate. So we're gonna charge 20% of the excess return. So now we assume the hurdle rate is 7%.
Okay. And could you define what hurdle rate is for me before we do the calculation? What is
I just shared that with you. So the
I see. So it'd be after the hurdle rate would be the variable. We calculate using the 20%.
Yeah.
Okay. And the management fee. Okay.
Yeah, the fixed fee is 2% of the
I see.
AUM.
Okay, so the management fee is the fixed fee. Yes, that's the fixed fee. And then performance fee would be, okay, the return 20%. Oh, I see. The return minus the hurdle. Okay, absolutely. And this is percent. Okay, absolutely. Yes. Okay. So we'll calculate the total fees for each asset class. So, and for each asset class being the leverage buyout, distressed debt, growth, and venture capital. The total fee. So the management fee being 2%. This is, would you like me to calculate for 2020, for the year 2020, or the average for all 3 years?
So I mean the actually you know we can, I mean we should calculate the expectancy.
Expected.
Yeah, what was the I mean, given that we want to launch a new product, we want to know what we could expect in the next year.
What we want to expect in the next year. Okay. So
the numbers shown in the chart are the their performance during the past years.
So I can take the average and make that assumption to take an average.
Yeah, you can do that.
Absolutely. Great. Thank you. So right off the bat, leverage buyout, the average of 13 plus 14 plus 15 being 40, 42 by 3, as we can average it to be 14. For distressed debt, that'd be 37 by 3. So it's about 12.33. For growth, it'd be 13 plus 11 plus 14 divided by 3. 34 divided by about 11.33. And VC totaling would be 43. So it would also be around 14.33. And so that would be the predicted private equity index return for the new year, for the year we were calculating for. The management fee of 2%, 2% of that multiplied by the return. Okay, so we operate on the 220 model where the management fee is 2% of the 2% of the asset under management, while the variable fee is the performance fee of 20% times the asset under management times the return minus the hurdle rate. So the hurdle rate being 7% and the return is, oh, and the return is given in the in our calculation. Return minus 7%. 7% hurdle rate. Okay, so the asset under management. So we have the fixed private equity firm, the yearly return, and the asset under management, we have 3 billion to invest in each asset. So using that, I can multiply 3 billion times 2%. Is that along lines? Is the asset under management figure, is that $3 billion for each
Yeah.
asset? Great.
Yeah.
So 3 billion times 0.02. And that's helpful. We can use that same number for all of the classes. So that would be 60 million. 60 million is the fixed fee, and the variable fee is different for each. However, the performance fee times is 20%. That would be 600 million, and then multiplying that each by the return minus 7. And so it would be, just quickly multiply that by the return minus 7. And so for leverage buyout, that would be 7% of 600 million. For distressed debt, that would be around 5%. And for the growth, it'd be about 4%. And venture capital would be around 7.33%. We'll add the 0.33 to each of those as well. So 600 million times 7% is going to be divided by 100 times 7, 42 million for the leverage buyout, and 5.33% of 600 million, 630, 30, 32 million. Right, 32 million. The 43 is on 6 divided by 5, 6. Yeah, it would be 32 million. 4.33 times 600 million. It would be 26 million, and 7.33 times 7.33% times 600 million would be 44 million. So adding that all up, the fees that would be paid for the leverage buyout would be 102 million for that year.
That's great. Yeah.
And then thank you. For distressed debt, that would be 92 million. For growth would be 86 million. And for venture capital, the fee paid would be 104 million. Right. And so those would be the total fees paid per asset class had we invested $3 billion in each asset under management. And so from this, it looks like the venture capital would be the highest total fee given our initial investment of $3 billion into that asset class. However, due to its high volatility, our client should look into whether this the high risk of investing in this asset class would our client tolerate the risk that they would need to consider in investing in this asset class. For $104 million in fees gained, our client may also look at leveraged buyout due to its much more stable past history of index returns. And so from this, I would recommend our client to look at the leveraged buyout as its highest, as its next product line to invest in due to its more stable history of index returns. And so from this, I'd like to look into introducing a leveraged buyout product line for our client.
Great. So what other factors you mentioned the volatility, that's great. So is there any other factors you think White Sands should consider?
Any other factors that White Sands should consider? Great. Could I have a moment to briefly structure my thoughts on this question?
Sure.
Okay. And just to clarify quickly, what exactly is a leveraged buyout?
You can just consider this is a product,
Is a product. Okay.
just same as equity and fixed income.
Okay. Absolutely. Great. So our so some of the factors that our client I would recommend to consider, I put this into both financial and non-financial factors regarding investing in this new product. First would be financially how we would introduce this product into our product line, primarily organic or inorganic growth. Whether it would be inorganic, whether we should acquire another company that currently has leveraged buyout in its product line, or work with some kind of joint venture with another, with possibly another bank that does this kind of financial product. And as well, another consideration is the ROI that we would have in introducing this leveraged buyout product into our product line, and whether the investment would ultimately, how long it would take to recoup that investment, or whether there's risk involved in ever recouping that investment due to the brand new nature of increasing in adding this product to our product line. And so for non-financial factors, I like to look at whether there are greater risks with leveraged buyout product than we might consider, and including as well global issues such as global conflicts that could affect the market, or pandemics, or any economic downturn, whether or not our analyst has any indication of risks in the overall market. So possibly introducing a new product line for our client, this may not be the best time for that, just due to other socioeconomic or political factors that may be affecting the world at the moment. And so so those would be some considerations I'd consider. However, given that this is a good time to invest, that there are no significant global pressures or conflicts that are occurring, I like to look at whether there are differences between organic or inorganic ways to introduce this product into our product line, whether it was an acquisition or a current, or just simply organically introducing this product to our product line without outside console. So is there any information on whether there are currently other smaller banks that form leveraged buyout, that have leveraged buyout products that we could possibly acquire? That would be my first thing I would like to look at regarding introducing this product to our product line.
Great. So the CEO is entering the room. Could you wrap up your thoughts?
Absolutely. So could I take a brief moment to structure my thoughts? Thank you. Great. So first of all, thank you for letting us work with you on this current problem. So in the objective of increasing profitability for White Sands Capital Partners, our recommendation is to invest and spend time into introducing a new product into the product line. Particularly the products that we would recommend would be the leveraged buyout and venture capital product lines for our clients. This reason is because after seeing that the current equity and fixed asset classes are decreasing in their fees that could be charged. We determined that introducing a new product would be most most advised for our client to increase its profitability. Some risk would include the operational costs of introducing a new product into our product line, particularly because this product is completely different from our client's current product offerings. So the next steps we would need is to see if the less risky product to introduce, the leverage buyout, would be best introduced by different modes of introduction, such as mergers and acquisitions, or organically coming up with our asset managers to come up with a new product, or whether or not we should joint venture with other banks or any other mode that we could use to introduce the leveraged buyout product into our product category. So thank you.
Great.
That was brutal.
Tell me what you think.
Well, if anything, I've actually learned a lot about the banking industry in this case. I think that was a really good plus. I very much did not understand, like I just didn't understand like just the nature of this industry. I didn't know like what different financial products there were. And so that was cool. That was cool to just learn about the industry. And the second, I'd say I wish on the second exhibit I just turned to the math immediately. Because they gave the formula on the bottom, and God, it seems so straightforward now that I think about it. Like the formulas on the bottom, the numbers were there. I asked what's hurdle rate, what's and you gave me them. It's just, gosh, had I just looked at it, it would have been pretty clear. But overall, it was very, very clear. I had no idea how this industry operated. But yeah, I think the directions I think had I known, honestly, had I known how this, frankly, had I known how this industry works and what the jargon was and how like the actual structure of this industry worked, I think I would have done a lot better. Like for example, the brainstorming, I just didn't know anything. I just didn't know what to offer. But in the end, like I think like, yeah, had I known more about the industry, because with the structure, I think I was fine. Albeit like not very customized, not a lot of details. With the exhibit, I just immediately saw, wait, everything's declining, and the active ones are taller than the other ones. And so, but had I known, right, that like the fees, we want lower fees, and so we would do passive, and and then the returns are the same, and so all this stuff. And then institutional is growing faster, and so focusing on that too. So exactly, institutional being this like venture capital, leverage buyout, whatever stuff, as opposed to retail, which should be like, I don't know, increase, like adding like a credit card or something, right? Or like adding more like brick and mortar stuff, or making a new app for our customers to use. So that's that's also huge. Yeah, wow, okay, yeah, because had it been the retail is growing faster, I was, oh, let's introduce a credit card, or let's put more brick and mortar stores, or let's offer more business loans or whatever. But instead, because institutional could have looked at with venture capital growth and all that stuff, and leverage buyout. So frankly, I think, and then, but as well, looking into the math for the second exhibit, because the first exhibit was definitely just like, okay, this is, that's what happens, take it, and then what's next, and brainstorm for new, whatever. And then the second one, I should have just seen all those numbers and think, all right, these are the past average, find the numbers out, do the calculation. And then once I did the calculation, I immediately saw, yeah, you get a small, slightly larger fees or return from the venture capital, but it's much more risky. And so from there, I'd recommend the leverage buyout, and then from there, factors that the factors that you would consider, yeah, organic, financial and non-financial, I think I came up with some good ideas. Albeit really standard like M&A or joint or ROI, like that's pretty just like, accounting 101 or, economic, accounting 101 class, MBA 101 class, and then non-financial was pretty surface level. But yeah, I think had I known more about this industry, which I do now, I think I would have done much better. But I think overall, I thinking about it, I actually didn't do that bad. So yeah, that's what I think. Yeah.
Well, several things. So, just follow up what you just mentioned. Is you mentioned you want you if you understand the industry better, then you could better deal with the case. And you mentioned the credit card, the brick and mortar things.
The app.
I mean,
Yeah.
actually, those are the services for not for asset management. Those are the services
Oh,
for banks.
oh,
So
not
that's one
retail.
thing.
Oh.
And so actually this case is I I think this case is does not quite focus on the brainstorm things, but you assume the case weighs a lot on the brainstorms, but it doesn't. So from the main problem, I mean, for me it's super obvious. So after I go through the whole process is you you jump into the case before you understanding the business, before you understanding their customers. And you could ask. So I already give you a lot of hints. There are two segments: retail and institution.
Yeah.
So and what's their, I mean, they behave differently. So how they behave differently. So and we have two kinds of products. Like one is active, one is passive, or where you can put the equity or equity or fixed income into consider, but generally the main difference is one's active, one's passive. So we have two type of products, and we have two type of customers. So how they behave differently, what's their appetite? So and you already drew the conclusions that all of our products are facing declining, right? They decline. Why they decline? Several reasons. So and then how to fix that? So in short, we need to figure out a product strategy. We need to launch new products. Then what kind of products? If you don't understand our customers, if you don't understand their pain point, if you don't understand what they need, I mean, you cannot launch a successful products.
Mhm.
So we always need to understand our customers. And if you don't understand, you could always ask. I mean, first of all, I mean, this is super hard. So it takes me like 15 minutes to just understand the industry and the products. And I used to work for finance industry, so it still take me that much time. And but
I didn't know. Yeah.
but however, even though you don't understand the industry, I mean, two things. First is you could ask, but you didn't ask from you ask a lot good questions, but very general questions, like where their locations and what about the
Yeah. Yeah.
competitors, but you didn't ask how they make money.
How they make money.
What's their revenue module, what's their business module, how they earn money by helping others manage their money. So you didn't ask how they make money, and that's one thing. And then moving forward, you didn't ask their customers. So what kind of, I mean, I keep mentioning there are two segments of the customers. So if you could ask more questions about our customer, understanding our customers more, so what our customers actually need, then it will accelerate the way that we tackle this case. So I think that's the main thing.
Main thing.
So
Yeah.
understand the revenue, understand our customers, and how they how they consume, how they pay for us. So that's the core about every business actually. So for some kind of like
Oh
like
my gosh.
the last time we do you asked me to do a football players, so that kind of behavior like we understand immediately because we do that, you know, we do that, so we can learn that from our everyday life. So we know we went to stadium, we buy tickets, and we buy food and drinks. But like in finance industry, we
No
don't
idea.
know that, you know, from our gut. So you better ask. You could ask. So what I want to understand more about how so what kind of factors our customers are considering? Are we facing a declining the so yeah, that's the main thing. So it's not I
Those
don't
things,
think
yeah.
it's about it's not about brainstorm. It's not, I mean,
Um,
brainstorm is
yeah.
important,
No,
but
I
for
hear
this
you.
case,
Yeah.
yeah.
I should have never went to structuring. I should not have went to without understanding the business. I should have taken the opening as an opportunity to understand. Yeah, I left right into structuring without having without no idea how this industry operates, you know, and I could have
Yeah,
asked.
and that's one
Yeah.
thing. And also you can always ask questions during the case. I think if you don't quite understand how they make money, you can, I mean, even though even though you didn't you I mean, even you didn't
I hear
ask
you.
questions at the opening, you can still ask questions later on. I mean, right. And also so you offer a lot brainstorm ideas, like you suddenly mention maybe we should consider housing or gold, or you mention a brick and mortar credit card. I mean, let's put that aside whether this is a good idea or not. So why you bring this up? So what's the logic behind that? So you remember the about the consulting there is all about logic, it's all about reasoning, it's all about also why you bring up these ideas. To me, it's like out of nowhere.
Yeah.
So why housing, why gold, or why gold is a good product? So
Yeah.
there is nothing
Nothing.
behind that. So then I mean, uh a good thing is you're being creative. That's really good. You are really being creative. So especially I love the part you mentioned about the overall market. So the overall economy, central banks increase the rates. I mean, that's perfect. That's really good. And that's really relevant to time. So I think that's super a big plus for when you're doing the structure. But also, but later on, so when you offer some possible solutions, then why? Right? So yeah, I already give you the overall thoughts. We can
Yeah.
go through the case pretty quick.
Thank you.
So this
Yeah.
is the descriptions and the and here, so for the answer clarifying questions. So I mean, it's like how they generate revenue. They generate revenue by charging a fee on asset under management, which means they under $5 $5 trillion. So they charge maybe 1%, 2% of the management fee. So that's how they make money. And that's how they make money. And then when you do the structure, and so when you I mean so when you do the structure and you can see that's a good structure and that's a very good structure. I think you mentioned the exposure to broader market. That's super good. And but the thing is you have three buckets, right? So revenue, cost, and overall markets.
Yeah.
So under the revenue buckets, I didn't see much details. So it's very general. You see, you say we want to see how the fee we charge, and then you're moving on the cost. But the revenue is super important. So when they evaluate how you structure the case, they will listen like the second layer and the third layer. But you didn't give me too much details about the revenue, so I don't think the revenue bucket is not solid. And I mean, about the revenue, there are too many aspects you could explore. For example, well, I could understand the customer segments. We could understand our products. So how about our product performance and about the pricing? And you can also use the price multiple the volume, like, right? That's the basic equivalent. So revenue is equal to price multiple the volume, right? So we want to understand how we price our products, how we price our services, and then you can notice that our pricing facing a declining. And then I want to understand our volumes. So our volumes, I mean, you can cut that depending on your preference. So the volume, we want to understand our product segments, or we want to understand our customer segments. Are we seeing any increase in the customer or any decrease in the product type? So then that's pretty clear. So price and plus volume, but you didn't mention that at all. So for the revenue, I think that's a basic thing, and that's also you could I mean, that's a great chance to show off your logic. And but so I think that's one thing that you missed. And then moving on is the those are notes about exhibit, but moving on is the first exhibit. So, and then moving on is the oh, by the way, oh, and there's still one thing that I want to mention. So when I describe the case, so I already it's
Yeah.
already implied in the case. So they want to expand their product offering. Right. So I mean that's kind of a hint as offer at the beginning at the descriptions. And then moving on about exhibits. So you mentioned you want to understand more about the revenue, and those are the product that we have at this moment. We're facing a decline, and so we want to, so all products are facing a decline in the price, but not in volume, right? You remember? So it's price multiple the volume. So the decrease in the price doesn't necessarily mean a decline in volume. And then we figure out the even though we are facing the price are declining, and the passive products are increasing. And because the return of the passive and active are about the same, so the passive is increasing, the volume of the passive is increasing. But that's, I mean, then that's the reason why we're facing a declining revenue, right? Because the passive fee is so low. And then how to fix that? How to fix that? Then how to fix that? So we need to find a better product that with higher return, that also is active and with higher return. Then we can charge higher fee, but with a better performance. And then yeah, so I think in the exhibit one, the good thing is you capture the main trend very quickly, and then you get the idea we need to launch a new asset class, and that's, you quickly get this 2 point. But then what kind of new class? And then you kind of get lost from there, and you start to throw out your brainstorm ideas. But why, right? And this part, and also another tricks I think you could take in mind is, now we're doing the exhibit, right? So this is not brainstorm.
You're
So
looking at exhibit,
then just do the exhibit, then just draw the conclusions, then just drive the case moving forward. Then we could, I mean, brainstorm is good, but don't let that
So what would be good is just like, okay, it looks like all the asset classes they're lowering, and all the, and it doesn't matter if it's passive or active and all this stuff. So we need to look at launching a new product that is not any of these things, right? So, and then we would have gone to like, oh, these are the products we're looking at. This is not a brainstorm exercise. This is just a direction to say, hey, we need
yes
a new
yes
product.
this is not a brainstorm exercise. I mean, I mean, if you are super confident about it, brainstorm. You could, and you understand the industry, and you could bring that up. And if you're, first of all, you didn't quite confident about the knowledge of the of this industry, and then this is not a brainstorm. Then don't show up your show right.
Yeah.
Then just show your logic, show your
Yeah,
logic, show your show your reasoning, and then and also I think, I mean, for the exhibit, probably that's it is really hard. I have to confess, this is really hard,
Yeah.
and probably because this is really hard, you kind of forget about driving the case. So I keep asking, so what's next? And
Yeah.
then you kind of forget about driving the case moving forward.
Yeah.
So actually moving forward, there are several things. So one is you need to reach to the conclusions. You need to reach to the conclusions like we need to launch a higher fee, a higher yielding products.
Higher fee,
That's one thing. So and also, and you forget about the cost. So you never analyze the cost during the whole. I mean, you have that in your buckets, but you didn't ask about the about the cost. So so we are facing a profit declining. There could be two reasons. Either facing a declining revenue or increasing a cost, or both maybe. So I mean, if in this case, cost is not primary factors, but it's always
should have
need
asked.
to ask. So what about the cost? And but I mean, you already have that in the structure, but it's kind of you just forget about it. And also, so for the product, you kind of you I mean, it's you probably think that's your responsibility to come up with the new product ideas, and maybe you could just ask, so what kind of products we have in mind? So what kind of products that in the market that we could consider to launch, and then they will show you there are like the 4 kind of products that we're considering to launch. So then that would save your brainstorm efforts. And actually there is a small brainstorm sections. That is, so after you got all the numbers, right? You remember? So I asked what kind of factors that you should consider. That is the brainstorm part. I mean, I mean, in this part, you offer really solid
Thank you.
yeah, really solid answer. You say volatility and financially and non-financially, and also you could consider about the non-financial factors, and you could consider like, here is the investor asset allocation constraints. So this is kind of a industry constraints, which means it's not that free, or it's not that easy to just launch a new product, because there are strings under regulations, like you can only invest in so and so. So and like in industry constraint and competition. So I mean, in this part, your answer is very solid. So yeah, great. I mean, that's come to the end.
Gosh, I just, man, I think okay. Yeah. Thanks, Ellen. Okay, cool. Thank you. Gosh, that was a little, oh my gosh. I'll be honest, I wanted to quit halfway through. I was about to say like, no, time out, we're done, but I'm glad I didn't. I'm glad in reality, like it actually, like the math was not that bad. It's just, gosh, I mean, yeah, gosh. I mean, it was a hard case. It was definitely a hard case. Yeah, but
if one thing, but I mean, overall, I think overall it's not bad, and especially this is a super hard case, and I think the key part is um you may want to practice how to understand customer, how to understand a product more. It's, for me, it's quite obvious, like you didn't even ask too much about the customer segments, product segments, and you have great strength in understanding M&A and financially, non-financially, and how to growth organic or inorganic when launch a product. I mean, what kind of factors that we consider? You have a great strength in M&A and launching good products, but what kind of product do we want to launch? And what how to satisfy our customers. So
Customers, yeah.
yeah, for me it's like you maybe you have not practiced so many cases about that before,
Yeah.
right?
Yeah.
Yeah,
Whatever. Yeah. Yeah.
but
Gosh.
that's not hard. I mean, focus on positive side. So today's case and show your weakness, and which is pretty easy to fix, and you have good brainstorm techniques. Yeah,
Yeah.
and
Yeah.
your brainstorm, I think your brainstorm is above the average.
Yeah. Okay. Thank you.
Yeah,
Okay. Cool.
so
Cool.
just one thing to fix: understanding the customers and product. How?
Okay.
Yeah.
Customer. Okay. Okay. Cool. Cool. Yeah. Yeah. Thanks. This is really eye-opening. Oh gosh. Gosh. Okay. Cool. Cool. Thank you. Um. Okay. Well. Yeah. I do you wanna go too? Or
Yeah,
how do you feel?
actually, I mean, yeah, you're right. This is Monday. I don't have. I mean, I
That's
still have
okay.
some job to answer, and
Well, I'll stop the recording right now. Yeah. Is that
yeah,
cool?